Hey everybody, Boris. Welcome to the Com Dollar Technicals for SEP 4 through SEP 8 2016 for Aussie dollar, dollar CAD, and Kiwi dollar. Interesting week for the Com Dollars because, of course, we have two, not one, but two central bank meetings this week. Starting off Tuesday night with Aussie, the RBA, and then Wednesday we have dollar CAD. Neither one of the central banks are expected to do any kind of movement, and I don't really expect the communication to be very different from the month prior. As a matter of fact, it's quite likely that given the relatively buoyant state of affairs out of China, and I mean that in relative terms, we're hardly in a boom economy in China, but the fact that PMIs went back above 50s, that Chinese demand seems to have, at least for the time being, stabilized, and therefore Australian growth has not really slowed materially, although we did have a blip last week in retail sales. There has been, don't get me wrong, I think Australia is in a secular slowdown, but the slowdown isn't as grave as the market had anticipated, and therefore does not necessitate any further rate cuts just yet. I do think, of course, the RBA is going to give lip service to exchange rate differentials. It doesn't want to see, it wants to see the Aussie much closer to 70 than it is at 75, but generally, it's unlikely that they're going to be uber dovish in this particular statement, and therefore yields and everything else on the Australian dollar should stay relatively the same. But it is kind of interesting. I'm going to show this to you on the charts. This is just as I talked about the idea of a trap on the majors. There is a potential here that that the Aussie downtrend, which we kind of saw really begin a couple of weeks ago, could continue. That whatever positive movement that we get off the RBA flows could actually be a fake out. So we'll take a look at the charts and I'll explain to you what I mean a little bit further. Dollar CAD is still really a yo-yo on oil prices as much as anything else. I don't expect the BOC to say anything of a real value. I think Governor Polis is going to be essentially neutral. They don't have much room to go down on the rates. They're not going to go and talk about negative rates at this point. The critical thing here, as far as dollar CAD is going to be the U.S. side of it, whether the Fed decides to hike rates, because then the U.S. to Canadian interest rate differentials are going to start to expand, and that probably is going to be positive dollar CAD. I still believe dollar CAD ultimately is one of the better dollar buys. I've been bullish the dips of dollar CAD for the last 3 months, and it's been a great strategy, as I've been telling you guys continuously. But because of the oil flows and because of the oil situation, it really muddies up the waters quite a lot. I'm not sure that the dollar CAD weakness that we saw on a relative basis for so long is really going to stay. As a matter of fact, there may be even opportunities now on the cross side to take the CAD to the upside, meaning that the CAD strength is going to start to show itself rather than CAD weakness that we saw for the last 3 or 4 months. And then last but not least, Kiwi dollar has nothing going on for right now. It's really sort of going to follow, I think, in Aussie's footsteps. The interesting thing here is the 73.50 has been a very rock solid resist point, and I don't see that breaking down anytime soon. But of course, the yield differential still keeps it bid on a relative basis. Let's take a look at the charts here to see where things stand. So Aussie support still at 75, that key level. Resist now is 76.50. CAD, the resist is 3,100. Support is 28. I mean, it's really nothing has really changed much on the commodity dollars from the week prior. The levels are pretty much the same. We've had very low volatility. As a matter of fact, I think there was a couple of days here where the Kiwi was like a 30-point range, 40-point range. It's been very uneventful to trade the Com dollars. I don't anticipate much movement here, although the central bank input certainly going to put in some volatility as the week progresses. Let's take a look at the charts here, and let me show you what I mean about the potential traps here. So let's start first with the Aussie. So when you look at the Aussie here on a longer-term basis, the first thing, or even on a shorter-term segment, let's just take a look at a segment of August. The critical thing I think that comes out here is a series of lower highs, right? The Aussie just can't get out of its way. The downward trend here is pretty well established, and that's a key thing here. Because suppose the scenario comes out like this. RBA is mildly hawkish. We get a pop back up above 76.50, but we can't really hold it and it gets reversed. That's the story. If that's the story, if that's the price action really doesn't hold the 76.50s to the upside, it's a very negative development for the Aussie. It makes me feel like it wants to then come back down and really test the 74.50, 7,500 support. The distribution here in the Australian dollar seems to be much more to the downside here, and that's why the price action will be much more important than the fundamentals, because if the price action ultimately reacts negatively to fundamentals, you have to really take the price action move here on the Australian dollar. And only if we kind of break back above 76.50 and hold it does the 77.50 come into view as a potential reversal. If that's the case, yes, you could have a very, very massive reversal here. And this whole segment then turns very bullish because you have a whole series of higher lows, and it becomes basically a move back up as a run towards fresh highs. But kind of a failure right at this point would really puts us right back on a path towards a much deeper test of the 74.50 support level. Now, Caddy is, ultimately, ironically enough, it's sort of acting as, it's really, if you look at it on a eagle's eye point of view here, it's really a range trade, right? It's sort of just been a great range trade. You sell the 31s, you buy the 27s, and you don't look back. I've sort of focused more, of course, on buying the dips. So just on the one side of the range has worked pretty well too. Anytime you can buy the 27s, it has worked for you over the long run. I still think as long as the 27s really kind of hold this whole series, we basically have a very ugly but still nevertheless prominent series of higher lows, and therefore the uptrend in the dollar continues. This also puts into play the whole notion that despite the stronger oil, despite the mild recovery, we do have a little bit of course, Canadian data. As a matter of fact, not only do we have the BOC, but then we have the Canadian employment data end of the week. That could be a very big tell because I think the Canadian economy is finally starting to catch the cold that the oil has produced, meaning that it's finally starting to feel the truly full brunt of the impact of the long-term secular decline in oil prices. And that's probably going to be net positive dollar CAD, especially if we get the boost the week following from the Fed. So to me, I still like buying the dips here until this 27 is violated. If that's violated, then of course the whole long thesis goes away. For now, that trade has been working since I started talking to you guys in May, and it's probably gonna, and I will continue to trade it until it stops working, basically. Now the next thing is the Kiwi, which is the quietest of all of them. Look at this little volatility. I mean, this volatility has just been pathetic. You're talking, this is not even like 100 points, and we've basically been in this 100-point range for a week and a half. The interesting thing on the Caddy is the failure at 73.50. Basically almost 5 times in a row. It's sort of the 73s, right? If you sort of look at it, the 73s as the failed point, because we can't seem to hold above it. We poke above it, come back down, poke above it, come back down. So the interesting thing here is also a very kind of a revealing structure on a price basis, because depending on how you look at it, beauty is in the eye of the beholder. Where is this a seller or buy? It's very difficult to be definitive about this. It still looks to be, if you sort of take the highs, the more dominant trade, of course, is that you fade the moves, that it's still a sell. But, and this is a critical thing, sometimes when you knock against the ceiling 3, 4, 5 times, and then the 6th time you kind of break through it, it's a rocket. This is something that I think very few people expect, and therefore you should be at least aware of the possibility. The move back through the 73s and a close, like a strong close above 73s, what would necessitate that? What would necessitate that is the market completely losing faith in the idea of a Fed hike. Then the yield story comes right back. Carry trade comes back into the Kiwi. The RBNZ has already said they're only good for another 25 basis point cut. So therefore, the yields still look very positive, and this whole upside segment really starts to take off. So my point is, short until it breaks 74s, and then you got to give up. Then you got to be you cannot fight that move. You're sort of safe shorting, assuming that the ceiling holds until 74. But if it comes out to 74, that's a major turn in sentiment, and you do not want to be in the way of that train. That could go to 75, 76 before it pushes out. It would essentially be repudiation of the whole dollar strong thesis that we've been trading for the whole week and a half. Kiwi is the most interesting in that way, because it is, of course, the greatest beneficiary of the repudiation of the dollar strong thesis. So I'd be watching that. Even if I'm not going to trade it, I'm just going to watch it as a sort of a canary in the coal mine for us in terms of where the market really thinks the Fed is going to go. Wish you guys the best of luck, the best of trading. Boris, over and out.